Hello guys, welcome to another video. Today we're going to talk about risk management. Risk management is the most important aspect of trading. Bad risk management can lead to the destruction of capital in your trading account and leaving you with little or nothing to trade. Capital is the main resource of any trading account. Make sure to preserve it well and treat it with care. An important lesson: never risk money that you can't afford to lose. The psychological toll will impact you while you trade and will make it more difficult for you. What does this mean? When you take a trade, and you feel like you're risking too much money, you'll notice that your eyes will always be on the charts. Why? Because you know you're risking way more than your account can handle, okay? So you're going to be constantly looking at the chart, see if price is going in your direction. If it's going against you, you're going to take a big gulp and say, oh, is this the right trade? Is this the right trade? You don't want that. You don't want that psychological toll on you. When you trade, you want to be completely calm. You want to have complete confidence in what you do. When you have complete confidence, it means that you're risking the right amount that you feel comfortable with. Okay, it means that once you take the trade, you can leave your computer screen. Okay, and you can go do something else. Okay, we're not looking to catch every pip out of the market. Okay, if we take a trade and it goes against us and we get stopped out, we get stopped out. That's the reality. Okay. Nobody's 100% and nobody's different. Okay, so make sure to risk an amount that you're comfortable with, and that you know that won't have a psychological toll on you. Stop loss is important. Should always be placed on market structure and not just fix a number of pips every time you place a trade. What does this mean? Well, when you start studying how price moves, okay, you'll realize that there is a certain structure in the market, okay, whether it be support and resistance, whether it be recent lows or highs, okay. You want to try your best to place your stop loss behind or above these levels. These are considered as pretty safe levels to place your stop loss behind or above, just because price generally doesn't touch that level again. And if it does, it means that usually the trade is going to be invalid. Okay, so if you go in a trade, let's say you go short Euro USD at any random number and you put a 23 pip stop loss, chances are you're going to get stopped out. Why? Because you're not putting it behind a proper structure. Okay, so this is really important to remember. Make sure to put your stop loss in a good area and not just, any random number. Okay. Stop loss is important. Just because you stopped out doesn't mean you should be upset. When placed behind a proper level of structure, stop losses are usually safe. Usually when they are reached, it just means the pattern level is no longer valid. So just like I just explained, once you place the stop loss behind these certain structure levels, okay, usually they're safe. And if price ever comes back to it, it just means the analysis was invalid. And it's okay to be wrong. Okay. Remember, a 1% to 2% loss is better than 25 to 50% loss, and those who have capital stand longer than the rest. Okay. You should always risk what you feel comfortable losing, not what anybody else says. If a pattern has an 85% chance of winning, what stops you from risking more than 1%? This is a game of probabilities at the end of the day, and you want to trade with chance. When you have a high chance of winning, you should look to risk more based on your trading plan. So what does this mean? So there are some patterns in the market that have higher winning percentages than others. For example, if we take harmonic patterns, most of them have higher winning percentages than wedges or triangles, for example. Okay, because why? Because triangles happen more often than harmonic patterns, which explains why the probability of the pattern is much higher in terms of winning percentage, because it happens much less often. Okay. So if you get a harmonic pattern and you know you have an 85% chance of winning, okay, based on your backtesting results, then what stops you from risking more than 1%? 85% chance is a very good probability. So why not risk more than 1% and go for 2 or 3? Because at the end of the day, if you're right, you're going to win more. Okay, it's obviously risk for reward, but 85% chance, that means you have to win almost 9 trades, okay, before you can lose 1, okay, which are really good odds in this game. Okay, if the trade involves you looking at your screen all the time, it means it isn't a good trade, or you just don't feel comfortable with the amount of lots you're trading. So this goes back to what I was saying before. If you find yourself in a trade and you're constantly looking at your screen, it means one of two or three things. One, it isn't a good trade. You don't feel comfortable with your analysis. Two, you don't feel comfortable with the amount you leveraged, okay? And three, if you think you have a good trade and you didn't risk anything else, if you didn't risk an amount that you're not afraid to lose, then that just means you have an extreme attachment to your money and maybe trading is not for you. We challenge you to trade with less lots and see how much more comfortable your trading will be mentally and physically. So what does this mean? If you were to risk 0.05 on a trade, okay, per pip, why not reduce it to 0.02, okay? And you'll see how much more comfortable you'll get, because once you're risking that low amount, you don't really, you feel much more comfortable because you know the loss is going to be smaller, and yes, the win will be smaller, but this is also a confidence thing too, right? So if you're losing a very small amount, okay, but you're also winning small amounts, the wins you'll see are going to have a much more impact on your confidence rather than the little losses, okay? Even if they are little wins, okay? The point is to train you to become a better trader, okay, and gain confidence. Once you gain the confidence in your strategy and everything you do, you'll see trading will be much more enjoyable for you, okay? What we don't challenge you to do is hedge your trades. It's almost impossible to do with high spreads, commissions, and unpredictability from the market. So what is hedging? Hedging is buying and selling the same instrument, okay, at different prices, okay? Why would you hedge? Reasons for hedging are, one, you don't know where price is going to go, so you want to buy and sell at the same price, okay, and try to see which way price is going to go. Well, that's kind of useless, because if you're just waiting to see what price action is going to do off the level, then you might as well not put any trades, save your commission costs, okay, and wait for more confirmation, okay? Another reason you'd want to hedge is, let's say you put a short trade and you see it's going against you, like in this picture, 5, 10, 10, 20. So you start buying along the way, okay? So you start buying in the opposite direction, but you see you'd still be in drawdown because you have two positions in drawdown now and you don't know what the market's going to do. So hedging is for people who are uncertain at the end of the day. And if you're not certain with the position you're taking, then you shouldn't be taking a position whatsoever, okay? Before starting to trade, it is important to note in your trading plan how much money you will risk on each trade. So in the first video, that was one of the things I suggested you guys do before getting into trading, okay? How much money are you going to risk on each trade? How much money is going to be in your trading account, okay? Is this money you can afford to lose? Is this money that are going to impact your expenses, your daily life, okay? This is very important. If you're using money that's not going to impact your daily life, you'll see that you're going to trade much more comfortably because you know you can afford to lose that money, okay? A more advanced trading plan will include the amount of risk that can be taken on each pattern or retracement levels. So going back to the harmonic patterns, if you have an 85% chance, maybe you're going to risk more on these patterns, okay? Or retracement levels. Let's say we get to the super important 61.8 retracement level on a Fibonacci retracement, okay? You might want to risk more because the probability of getting a good trade off that level is much higher than, for example, a 31.8, okay? So make sure to have a detailed trading plan, okay? So just like poker, you feel more comfortable with 4 of a kind or a straight flush than you do with a pair or nothing in your hand. The only difference is you can't bluff in trading. So, so this makes perfect sense. If you have a 4 of a kind or a straight flush in your hand, okay, you know you have much higher chance of winning than if you had nothing in your hand, okay? And there's no bluffing in trading because the broker is the house, right? And usually in poker there's no house. It's you against versus all other players, right? But in trading we actually have a house. So we want to play the house. We're playing against the house, but we're playing with probabilities, okay? Thank you for watching another video, and I'll see you in the next video.